Wesfarmers has withstood earlier floods and earthquakes, as well as the high Australian dollar, to lift full-year earnings by 23% to just under $2 billion. The Coles Group again contributed strongly, but insurance earnings were badly affected by the natural disasters. The company remains upbeat about the future and lifted its dividend by 21%. Emily Stewart has more.
Economic uncertainty and a number of natural disasters have buffeted Wesfarmers' many operations this year, but the company seems to have weathered the storm.
The results show, I think, the benefit of diversity. The portfolio businesses we've got is very strong.
Most of the businesses are performing well, and quite frankly, I think I prefer to have a diversified business in this environment than be fully loaded into one or two divisions that might have gone backwards.
Wesfarmers posted a full-year net profit of $1.9 billion, up 23% on last year. Revenue was up 6% to around $55 billion. The company's biggest earner is the Coles supermarket chain. It's managed to increase earnings by 20% despite a tough retail environment. But retail analyst Jason Darling says it's still underperforming.
Supermarkets tend to have reasonably defensive earnings. Part is also because they have a new management team and a new strategy which is trying to invigorate the customer and get the customer back to Coles. But also part is really because Coles is just clawing back some of the underperformance it's had over the last 5 to 10 years.
One of their tactics has attracted a lot of heat. Coles started the $1 a litre milk price war, prompting concerns that dairy farmers will lose out.
The Coles people are doing some genuine work with dairy farmers to ensure that we continue to have long partnerships with dairy farmers supplying us into the future.
The Bunnings and Officeworks stores continue to do well.
Well, Bunnings is a consistent performer, and I think it's really a category killer. It's preparing itself really for the entry of Masters, which is the Woolworths hardware brand. So it's really been lowering prices, making sure that its offering is right. And a lot of people don't consider hardware to be a discretionary spend.
In the value retail sector, a resurgent Kmart appears to be eroding Target's customer base, but analysts blame other factors.
The difficult result out of Target this year really comes down to the difficult retail conditions, and I think it's very difficult to plan your sales in very volatile times.
We're seeing consumers trade down in where they shop. So we're seeing people move from buying at David Jones to Myer down to Target and into Big W and Kmart. And that reflects the frugality of consumers at the moment, particularly in the June quarter.
The insurance sector was hit hard by the floods, Cyclone Yasi and the Christchurch earthquakes, with earnings down 84% to $20 million. Meanwhile, the natural disasters cost the retail division $100 million, only 60% of which was covered by insurance. Its coal division too was badly affected, and Wesfarmers predicts a loss in earnings of between $200 and $300 million. But a rise in the price of coal helped to offset those losses. But the losses don't seem much when compared to Wesfarmers' spending plans for this year. The company will increase its capital expenditure program by around 40% to $3 billion.